as you can see, our third quarter market update. So we're going to check in and see how the market's gone so far this year, what's happening right now that we need to be thinking about, and kind of what we're seeing going for the rest of the year for the fourth quarter here. So let's go ahead and dive right in. First, here's the stock market for the year. This is measured using, you can kind of see right over here, the SPY. That's the the index that tracks the S&P 500, which is basically the 500 biggest companies. And you kind of see it's going up and down throughout the year, but guess what? Year to date, at the end, now I did this in October, mid-October is when I pulled this, so it's gone down a little bit, but basically for the first three quarters of the year, it's up around 15%, give or take. So not a straight line, but ups and downs as we would expect. Here's the crazy thing. I don't think any of us were expecting the markets to do so well so far this year. I'm going to talk more about that in a minute. But hey, that's pretty good. Stock market up about 15. Yay, we like that. How about the bond market? Well, that's this next page right here. Not so good. Now, AGG is kind of the index that tracks what's called the aggregate bond market, which is a mix of government bonds and corporate bonds and all that kind of stuff. Anyway, you can see it started up higher, and that one's kind of trending down this year. Now, that's a reflection, by the way, of interest rates. When interest rates rise, bond values fall. So think about it. Remember when we were in grade school, we had that seesaw or teeter-totter? Think about it like that. One side goes up, the other side goes down, and vice versa. We've seen this year, interest rates are starting to rise a little bit. Nothing exciting yet, right? But they're starting to rise, and we're seeing that impacted in bond values. Now, the reason I show you this is as follows. The biggest, maybe not the biggest, but one of the biggest mistakes people make when it comes to their investment plan, especially if you're getting close to retirement, is, I'll go back to this one, the S&P. You're like, oh, how am I doing compared to the S&P 500? That's a really bad thing to track, because now if you're my daughter's age, Sarah, she's 27, and she has almost all of her money invested in stocks, then yeah, that's probably a pretty good benchmark. But when you're retired or you're nearing retirement, that is not a benchmark you want to track anymore, because there's a lot of risk in that benchmark. We're going to cover that in a few minutes. So you might say, hey, am I up? How's the market doing? Am I up that much? That's a bad question, right? That's not the question you should be asking. You should more be asking, what's my target rate of return that I need to accomplish to achieve my goals, and how am I doing compared to that? That's the question you really should be asking. All right, let's talk about why this is so important, because, by the way, most people who have balanced portfolios, you have a mix, right? You've got some stocks, some bonds, and if you've got a 50-50 portfolio of those things, you might be up like 5% or 6% because the bonds have gone down this year. All right, this is why you don't want to use the S&P 500 as a benchmark, especially, now if you're younger, it's fine, but when you're older, this is a bad benchmark. Here's why. Lot of risk. So we watch, and if you've been watching us, you know that we track this. There's something out there called a Buffett indicator, or the Warren Buffett indicator. So what Warren Buffett likes to do is he's got a little mathematical relationship, if you will, that tracks, for his purposes, is the market overvalued or is it undervalued? And what he does in very simplistic terms is he's comparing, he takes the total market value, like he takes the value of the entire stock market, and he compares it to what's called GDP, gross domestic product, which is essentially the value of all production or all of the entire US economy, right? So what's the value of the stock market compared to the value of the economy? And there should be a range that it falls in, and that's right here. This I don't know how well you can see it on your screen, but it's this yellow, kind of like this line right here. That's where it should be. And you can see for the most part it's within that range, but sometimes back here in the 1960s, it got above the range. And other times, like right here, the 70s and early 80s, it got below the expected range. Now, when it's above the expected range, that would indicate that the market's overvalued. And so Warren Buffett, the reason he uses this is he says, hey, if the market's overvalued, I want to be really careful about buying new positions, and it might be time to start holding more cash, and that's okay. When the market's down here and it's undervalued, it's like, okay, now's the time to buy in the market. And normally, the markets are doing well when it's higher. They're doing poorly down here, so it's kind of hard to buy in when the markets are doing poorly. But how do we make money in the markets? We do what? We buy low and we sell high, right? That's how we do it. So here's why this is a really important chart for you right now. Notice how high we got. See this red line up here? That's like danger zone, like big time. You know, danger, Will Robinson, danger, right? And up here, when it gets up by that red line, like it did back here in the late 1960s, normally the market's very highly overvalued and it does very poorly for the next period of years. In fact, from this point here, over the next 10 years, the market's only earned, a couple percent a year, basically broke even. In other words, from that point, for the next 10 years, people made no money in the markets. The 70s, by the way, stagflation, it was a really tough time. What happened here? It says internet bubble. What happened here? That was 2000. Do you know what the stock market earned from this peak up here in the internet bubble? You know what it earned for the next 10 years? Try negative 1% a year. It lost money for the next 10 years. How would you like to have your money tracking an index that loses money for 10 years? This is why it's a horrible, horrible index for people who are retired or nearing retirement, because it's not going to help you. But look where we are now. We are at one of the highest points it's ever been historically. Talk about markets being overvalued. It's more overvalued now than it's been at any point since we started tracking this back in 1950. What does that tell us about the future? Does it tell us that, it was really high back here and the market basically earned nothing for 10 years, and it was really high back here, so the market earned basically nothing for the next 10 years? Does that mean that the market's going to earn essentially nothing for the next 10 years? Well, the answer is this: we don't know, right? We don't know. But we got a pretty good sneaking suspicion, as my mother would say, right? When we get this high, it's pretty darn likely that markets are going to go poorly. And by the way, it usually starts off with a big crash. Back here, back there, markets over 73, 74, markets lost half of their value. Here, 2000, 2001, 2002, markets lost half of their value. Now we're even higher. Could markets lose half of their value in the near future? Yeah, they sure could. And if you're retired or nearing retirement, do you want to have all your money tracking something that could lose half of its value over a short period of time? No, that's really bad planning, right? So don't be using the S&P index as a benchmark, right? That's one thing. But the second thing is we need to understand where we are in the economic cycles. And right now, we're not in a very good place. Markets are wildly overvalued right now. But with that being said, remember this. Markets are driven in the short run by emotion. They're driven in the long run by charts like this, which are fundamentals. All right? So short run is emotion, long-term fundamentals. So let's keep going. What's going on right now? What's going on right now? Well, the big news these days is the big I. Right? That's an I, not a one. It's an I, letter I. What am I talking about? Well, I think you know what I'm talking about. Suddenly, we're talking about inflation again. Where the heck has that conversation been for the last 20 years? Gone. There's been essentially very little to no inflation. But notice what just came out. This just came out this week. Social Security cost of living adjustment for 2022. How much are they going to benefit? Do you know? Did you see the news? Did you see it? Here's our number. 5.9, call it 6%. Basically, Social Security, the index that they use to track inflation, says, oh, we got inflation, we got to bump up your payments by 6%. And if you're receiving Social Security, yeah, that's awesome, you're getting more money. If you're not yet receiving Social Security, yeah, you're still going to get a benefit of that, because it's included in your calculations. Here's the deal, though. If Social Security says inflation 6%, what do we know? Well, we know that Social Security is actively using a calculation that shows a lower rate of inflation than what's really happening out there. So if they say 6, what do we really know? Right now, thank you very much, COVID, and thank you very much what they're doing in Washington, D.C., inflation is actually, at least for the short run, this is not long term, but for the short run, probably breaching double digits. We're probably north of 10% right now. And by the way, where do we see that? Well, how about the price of a steak? I had a great conversation with a client recently, and they were telling me, Mike, we went to get some ribeye or some steak for to grill, and holy cow, the price of meat has doubled over the last couple of weeks, right? That's happening. How about this one? A housing market. By the way, this is another chart we look at. The green line on the bottom represents rental prices. The red line on the top represents the value of homes. Rental prices for real estate, like you go out and rent a home, it goes up essentially with inflation. And here's the deal. That red line, the price of a home, should be tracking that pretty closely. But is it? No. What happened in the early 2000s? It went way up. And what happened in 2008? We reached a peak, housing market crashed, and it affected the stock market. What's the housing market doing right now? Hey, if you're here in Austin, you know what it's doing. And pretty much everywhere else in the country, it's going through the roof. What does that tell you? Is that red line going to keep going up like that forever compared to the rents? Answer, by the way, is a big fat no, in case you were wondering. This thing's going to go down. Likely we're heading towards another housing market crash based on this bubble that's developing. But again, how long? We don't know. How long before it starts? We don't know. Emotions rule markets in the short run. Fundamentals like this rule markets in the long run. This tells you if you're buying a house right now, don't expect a lot of appreciation over the next 10 years. And then, how about the gas pump? Right? We all have to get gas unless you own a Tesla or something. We know gas prices have been going up even here in Texas. Here we go. A year ago, that's right back here, national, for the entire country, the average price of a gallon of gas was about $2.05, maybe $2.10. What is it today? $3.30. The price of gas in the last year has gone up 50%. 50% more money to fill up your car. Plus what we're seeing at the grocery store, plus what we're seeing to buy a home. Yeah, inflation is definitely here. Maybe not long term. This might be just an impact, if you will, of COVID and messing up with the supply chain. This might be something that's just short term, but it's certainly something we need to pay attention to. Okay, and then with all this going on, the Democrats have decided we're not spending enough money in Washington, D.C. We got to spend more money because, government doesn't spend enough apparently. They feel like they got to spend more money. They've released this $3.5 trillion budget spending bill. They've got the $1 trillion infrastructure bill. I mean, they're just looking to spend money like crazy. But they tell you, and by the way, I love this. They tell you, oh, it's okay though, because we figured out how we're going to pay for all this extra spending, right? They figured it out. And by the way, if you ever go to usdebtclock.org, you can see that politicians in general, when it comes to managing money, are complete morons, right? They're horrible at managing money. They manage money. In fact, teenage children manage their money better than the politicians do in D.C. And I'm not talking about just the Democrats. I mean, both sides of the aisle are equally guilty. But they say, we know, don't worry. Yeah, we want to spend all this money, but it's cool. We got it covered. Here's how we're going to do it. We're going to, as AOC says, she wore a dress about it, we're going to tax the rich. Yeah, that's what we're going to do. We're going to tax the rich. Now, I've been around for a while, and I know you have too. Every single time in Washington, D.C., they say we're going to tax the rich. What happens? Is that really what happens? No, they apply these taxes to the rich, who happen to have really smart CPAs and attorneys, and the next thing you know, it's not the rich paying the extra taxes. It ends up trickling down to who? Yeah, down to you and me. We're the ones that end up paying for it, aren't we? Whether it's in inflation or higher tax rates, etc. So every time I hear politicians say this, I just cringe, because I know that's not what happens in the real world when all is said and done. And you know what? You probably know that too. Now, and by the way, if you actually look at the share, are the rich paying their fair share of taxes? They pay like I think I saw recently the top 20% or the top 10% of, and by the way, I don't have this in front of me, so please don't, you could probably research this and get the numbers, but something like the top 10 or 20% of income earners in this country, they pay like 80% of the taxes already. So, and I did see that like half of the people today, essentially after credits and all that stuff, don't pay any taxes hardly. So the rich are already kind of paying all the taxes, yet apparently they're supposed to pay more. Let's be honest though, anytime they want to tax the rich, you know as well as I do, it tends to float down to the middle class. And by the way, if that picture right there isn't the definition of irony, I don't know what is. All right, with all that being said, what's our outlook for this quarter? Because so far I'm not seeing a lot of good news here. I mean, mostly it's all pretty negative from what we're seeing in the news, right? And that's normal because the news is really good at sharing negative news, not positive news. But this is what I would tell you. The fourth quarter is always the quarter about one word, and that word is volatility. What does volatility mean? Big ups, big downs. October, historically, if a market starts crashing, October is a month that it likes to start crashing in. Normally, November, December are months that tend to be pretty decent for markets. Normally in the fourth quarter, you see lots of ups and downs, lots of volatility. Big moves up, big moves down. Expect to see that here in the fourth quarter, the rest of the year. Is the market going to move up or down from this point? Hard to say. It could go either direction, but just expect lots of ups and downs along the way. Here's the other piece of news I want to share with you, though, and it's really this last item. That's not always a bad thing. So this is what I want you to know. There's a saying in the financial industry, and I found this saying to be very true over my 26 years. The market grows on a wall of worry. In other words, when people are always worried, they're always like freaking out about something, whether it's inflation, whether it's the market's overvalued, whether it's the housing market, whatever it is, the market tends to grow in periods of that time. That grows on a wall of worry. When do you have to be worried about the market crashing? It's when we reach a state of euphoria and FOMO, fear of missing out. In other words, when everybody is piling on, when you're sitting there going, I've got to get in the real estate market or I'm going to miss out. I've got to get in the stock market. Look at all these gains or I'm going to miss out. When we see that type of activity, that's normally when emotions have hit their peak, and that's when the markets start crashing. That's when the fundamentals start really shifting in. And I got to be honest, I don't see that quite yet. I'm definitely seeing signs of it. But in conversations with people, I'm still hearing more people worried about the market crashing than people who are saying, oh my gosh, I'm missing out. I've got to get in the market. So again, Past performance, no guarantee of future results. What happened in the past is no guarantee it's going to happen in the future. I will tell you, though, that markets grow on a wall of worry. We've seen that over and over. And they don't normally go the other direction in a big way until everybody is dying to get into those markets. So I'm actually cautiously optimistic right now, if that means much of anything. Cautiously optimistic. Again, we do use with our investing, we use a lot of algorithms to help protect us, right, from the risks of the market. But at the same time, we want to capture at least decent upside when we can. And overall things seem to be going pretty well. So there you go. That's what's happened so far this year, what's happening right now. So far, markets are doing well, except stock market good, bond market bad. We've got inflation is something we're worrying about right now, and new government spending. Those are kind of issues we have to deal with. And as we look forward for the rest of the year, I think there's going to be lots of ups and downs, but I'm cautiously optimistic because I see more people worrying than I see people super confident. How's that? All right, that's our message. I hope you found it helpful. If you have any questions, just go ahead and reach out to us. But I hope you enjoy the rest of your day.